as you can guess. Over time, investment activity became so sophisticated that investors started specializing for different types of opportunities. Some of them are looking for fast-growing companies, others for mature cash cows, third for special restructuring cases, others for price arbitrage, and so forth. And all those opportunities have different characteristics that you have to pay your attention to. It's not just about SWOT analysis or financial analysis. As you will see, there is much more. Market positioning approach. Here is the point to have a company, usually positioned as number 1, 2, or 3 in an attractive industry, waiting for the right strategic partner looking to enter the market. To reach that position, an investor will approach the investment in an earlier phase of industry development. Or it will create a sound player by combining a few mid-players into a single large player. Here is the point on sales as a primary KPI, while other operational and financial indicators will be a subject of performance improvement measures between an entry and exit momentum. That is the logic of a financial investor. Strategic investors usually have the same desire, but due to sometimes very rigid bureaucratic corporate approvals and perceived risks, they are either a bit late, meaning that is why they will buy it from a financial investor, or they will approach it organically if they still have a sound entrepreneurial spirit. Price arbitrage. Here is the point to find great companies, but either operating in less attractive markets or to have some other sort of a damage that can be either fixed or covered. As a result, an investor will enter at, for example, 6 times EBITDA and exit at 8 times EBITDA in 3 to 5 years. What does it mean in practice? For example, companies are differently priced depending on a region they operate. You cannot apply the same valuation multiple for companies operating in the UK or Germany compared to companies operating in Hungary, Latvia, or Serbia. Why? Simply, perceived risk and market liquidity are different, especially from the standpoint of end investors, usually coming from Western countries. So, some financial investors buy companies in different geographic regions simultaneously and combine them into a single acquisition platform. Usually, companies in less attractive markets are smaller and can be camouflaged, but can still improve total financial indicators and, later on, to be priced at a higher multiple at the exit, just like the rest of the platform, since it is now a unique package. Or some companies are less valued due to some other factors. For example, an entrepreneur is deeply involved in the operations and decision-making processes that if someone acquires his company, it will take a few years to establish a professional management and procedures and make the company free from its own founder or entrepreneur. Or just a capital structure might be wrong, for example, huge debts and tiny equity, making the company to be perceived as too risky. And some investors are motivated to help in those kinds of transitions, being a middleman and earning at a price difference. From the standpoint of strategic partners, they are less motivated by those quick wins and playing at a price difference. They are long-term players, usually leaving these opportunities to financial investors. Restructuring potentials. This is another opportunity, usually exploited by financial investors. It refers to companies in struggle, meaning with liquidity issues due to tiny cash flows and significant liabilities, but rich in assets. In this case, a financial investor enters a deal with an idea to sell the company in pieces. He will identify which parts of the company can be improved, either with additional investments or cost-cutting measures, and which will be sold as assets to some other strategic or other investors. The main idea here is to buy it cheap, keep the company floating while selling it piece by piece, repaying debts from the money coming from disposals and making the profit at the end of the day since the sum of the parts should be higher than initial investment. Strategic investors usually stay away from such deals since it requires a lot of attention to details, hard negotiation skills, and bargaining, while dealing with a lot of non-core activities. An exception might be a target with strong brands and market presence, but with outdated technology or weak management team, causing its low performance. Strategic partners may decide to enter and turn around the company. Other special cases, it refers to participating in specific deals like MBOs, meaning management buyouts, acquiring family-owned businesses when founder decides to exit while he does not have a proper successor, supporting exit of a partner when there is a power struggle between partners, supporting a company's internationalization process, and similar. In these cases, financial investors will act as sponsors if they find a project interesting. They will define specific requirements they have to fulfill, on top of the money, like providing a proper management team members, finding a right acquisition target or end owner, lobbyists, etc. Usually, strategic partners rarely participate in such specific deals because it is a risky deal and requires a fast response. Mature cash cows. In this case, the company is usually acting as the one that makes acquisitions. Simply, it is in a position either to pay huge dividends to owners or to find attractive projects or targets to spend the money. And, as you can guess, professional managers prefer the second option, increasing their power. Just imagine Microsoft or Coca-Cola. They are lacking internally created opportunities in their core businesses, and they are looking for other options to find sources for long-term growth. On the other hand, financial investors find those companies attractive in two cases, LBO type of a deal, or to use this company as an investment vehicle to acquire other companies and create even bigger companies that they will sell in the next stage. Improving value chain and resource base. This is also very characteristic for strategic partners, and it is driven by potential synergies. Simply, companies are looking for the targets that look complementary to them, to acquire additional operations that will improve or expand their value chain up or down the process stream, or secure them resources, which is especially important in businesses relying on natural resources. In addition, potential targets might be companies that expand their product portfolio, have a significant brand, or have introduced an interesting business model, or some other know-how from which the company would like to learn. Financial investors are usually lacking the complementary part of the equation, and that is why they are usually not participating in this type of the projects. An exception refers to situations when a financial investor enters the market with an idea to create a strong player by acquiring a few companies, exploiting production capacities and logistic advantages. This is the case when a company is trying to exploit economies of scale. It already has a strong production capacity, sales network, or logistics, and would like to increase the utilization. In this case, the company will look for the targets that will help to fulfill the mission. Another option to M&A deal is to enter another form of strategic partnership with other companies, where those companies will serve as an extension. For example, they will use logistics from this company, sell their products, and similar. Just like in the previous case, financial investors are lacking the complementary part. License-based business, looking for the cheapest option for market entry. In a license-based business, it is common to see M&A deals driven by acquiring a license. Simply, a company needs a license in order to operate, enter some market, instead of applying for a license, if available, and waiting for approvals. The company will pick the available target from the market in order to speed up the process. For example, the banking sector is heavily regulated and such kinds of M&A activities are very common here. And as you can imagine, there might be other preferences by investors compared to those 8 that we have just mentioned. And all those M&A drivers and different characteristics should be defined in advance. And prospective investors will create a sort of a scoring system and rank available investment opportunities according to his preferences. Yes, it is much more complex compared to SWOT analysis.